Welcome to this extensive guide on two of YieldMax's most dynamic exchange-traded funds, MSTY and ULTY. These ETFs are designed to deliver high-yield income through sophisticated covered call strategies, making them attractive for investors seeking to generate substantial cash flow, whether for retirement, supplemental income, or financial independence. In this presentation, we'll dive deep into the mechanics, performance, benefits, and risks. We'll explore practical strategies, historical context, and real-world examples to help you understand how these ETFs can fit into your investment goals. Please note that this guide is for entertainment purposes only and does not constitute financial advice. MSTY and ULTY are innovative ETFs offered by YieldMax, a company renowned for its high-yield investment products. MSTY is uniquely tied to MicroStrategy, a company that holds significant Bitcoin reserves, making it a leveraged proxy for Bitcoin's price movements. This single-stock focus positions MSTY as a high-risk, high-reward option for investors bullish on Bitcoin's long-term potential. ULTY, by contrast, operates like a hedge fund, holding a diversified portfolio of 15 to 30 underlying securities, actively managed to maximize income by capitalizing on high implied volatility. Since their inception, both ETFs have delivered impressive performance. MSTY has achieved a total return of approximately 300%. Driven by MicroStrategy's volatility and Bitcoin's price surges. Over the past year, however, their share prices have faced challenges due to market volatility, with MSTY down 38.98% and ULTY down 49%, without factoring in distributions. When including distributions, MSTY's total return is a remarkable 91%, and ULTY's is 27.3%, outperforming many market indices, like the Nasdaq 100, which returned about 5%. MSTY offers several compelling advantages for income-focused investors. Its primary appeal is its monthly distributions, currently yielding around 90%, driven by the high implied volatility of MicroStrategy stock. Consider an investor with $100,000 allocated to MSTY. At a 90% yield, this could generate $90,000 annually in distributions, assuming the yield remains consistent. For those comfortable with high risk, MSTY can be a powerful tool for building wealth, supplementing retirement income, or achieving financial freedom, especially when Bitcoin surged 50% in a single quarter. ULTY, with its weekly distributions, offers a different value proposition. Its diversified portfolio of 15 to 30 holdings reduces single-stock risk, making it a more balanced option than MSTY. For instance, a $50,000 investment in ULTY could generate around $44,500 annually, or approximately $856 per week at the current yield. ULTY's hedge fund-like structure, with active management and protective puts, provides a degree of stability not found in single-stock ETFs like MSTY. MSTY's high yield comes with significant risks that investors must carefully consider. As a single-stock ETF tied to MicroStrategy, MSTY is exposed to headline risk. In a down market, MSTY can experience substantial drawdowns, as evidenced by a recent 10.4% drop over 5 days, compared to Bitcoin's 3.78% decline. Net asset value erosion is another concern. YieldMax prioritizes distributing income over preserving NAV, leading to significant share price declines during downturns. ULTY, while more diversified, is not without risks. Its high yield of 89% reflects its exposure to volatile, high-beta securities, some of which are unprofitable companies. For example, during a recent market correction, ULTY fell 4.3%, underperforming its hedge, YQQ, which gained 1.54%. ULTY's portfolio includes leveraged ETFs, such as triple-leveraged QQQ or small-cap ETFs, which increase downside risk in bear markets. To fully appreciate MSTY and ULTY, it's useful to examine their performance in historical context. During Bitcoin's 2020 to 2021 rally, MSTR surged over 400%, driving MSTY's exceptional returns. When factoring in distributions, MSTY's 91% total return demonstrates its strength as an income vehicle, outperforming the S&P 500's 7 to 10% average annual return. Historical data shows that ULTY's active management has maintained stable income, even during periods of elevated volatility, such as when the VIX spiked above 40. Investing in MSTY and ULTY during a market downturn requires a strategic approach. Financial experts recommend allocating no more than 3 to 5% of a portfolio to high-risk assets like MSTY, For example, a $1 million portfolio might include $30,000 in MSTY, $20,000 in ULTY, and $950,000 in index funds like Cornerstone's CLM or CRF, which yield 20%. Hedging is another essential strategy. For MSTY, YieldMax's winter ETF provides an inverse position, offsetting losses during downturns. During a recent 5-day period, winter gained 6% while MSTY fell 10.4%, illustrating its effectiveness. Margin investing can amplify returns but requires caution. Using margin in a brokerage account allows investors to increase their exposure to MSTY and ULTY, boosting income. For example, a $1 million portfolio with $200,000 in margin could allocate $100,000 to MSTY and $100,000 to winter, neutralizing risk while generating income. To balance the risks of MSTY and ULTY, investors should prioritize index-based ETFs for stability and compounding. Cornerstone's CLM and CRF are exceptional options, offering a 20% dividend yield. For example, during the 2022 bear market, Cornerstone's NAV drip allowed investors to buy shares at discounted prices, boosting long-term gains. By allocating 95% of a portfolio to indices and 5% to MSTY or ULTY, investors can achieve a balanced approach combining high income with long-term growth. For investors aiming to live off dividends, MSTY and ULTY can be powerful tools when used strategically. A portfolio yielding $600,000 annually requires careful position sizing and risk management. For example, $100,000 in MSTY could generate $90,000 in annual income, while $100,000 in ULTY could yield $89,000. To sustain this lifestyle, investors must mitigate drawdowns. During a recent sell-off, MSTY's 10.4% decline was partially offset by its income buffer. NAV erosion is a significant concern with YieldMax ETFs. To protect NAV, investors can reinvest distributions to buy additional shares at lower prices, effectively dripping at NAV. Advanced investors may use put options on broad indices like QQQ or SPY to protect their entire portfolio. During a recent sell-off, such options gained 100% in a single day. Allocating 1 to 2% of a portfolio to options can provide significant downside protection without sacrificing income. For investors seeking to maximize returns, advanced strategies can enhance the performance of MSTY and ULTY. One approach is to combine these ETFs with leveraged index funds. Another strategy is to participate in Cornerstone's rights offerings, which allow investors to purchase additional shares at discounted prices. Selling options on MSTY and ULTY can also enhance income. By selling covered calls or cash-secured puts, investors can generate additional premiums. MSTY and ULTY offer unique opportunities for income-focused investors, but their high yields come with significant risks. MSTY is ideal for those bullish on Bitcoin, while ULTY suits investors seeking diversified weekly income. To succeed with these ETFs, allocate no more than 3 to 5% of your portfolio to MSTY or ULTY, with the remainder in stable index funds like Cornerstone CLM or CRF. For further learning, resources like Unconventional Wealth Ideas offer guides on high-income investing. Visit their website for a 10% discount using the code MARCOS or contact them at akintud48@gmail.com. Stay informed, stay diversified, and always factor in distributions when evaluating these ETFs. Thank you for joining me in this comprehensive guide to MSTY and ULTY. Keep learning, keep investing, and take control of your financial future.